אוליבר קאר, שלמעשה שמו המלא זה אוליבר קאר III, ואם שמעתם, אבא שלו, של אוליבר קאר, שהוא בן 91, הוא אוליבר קאר ג'וניור, כי הוא בן של אוליבר קאר המקורי, שזה הסבא של אולי. אני יכול להגיד לכם שלפני שנה, האמת היא שאבא של אולי גם אחד המשקיעים בחברה, יש לו כמה 3 או 4% בחברה, פגשנו את הג'וניור. הג'וניור בן 91, ואני אומר לכם שאם תסתכלו על שמעון פרס, הוא זקן לידו, חד משמעי, לחצנו לו את היד, אז היד נשברה, יש לו עסקים נרחבים גם היום, הוא בא כל יום לעבודה, איש מדהים, ואולי הוא נצר למשפחה הזאת, דור שלישי של בוני נדל"ן בוושינגטון. אוליבר, please, the floor is yours.
Thanks. So I heard a lot of Olivers. I got that part right. So, well, thank you very much for having us today. First, I want to start really with a thank you to both Ohlone Hetz and to J.P. Morgan. Both have helped us really transform as a company, and the expertise and intelligence and support they provide us is really unparalleled. So we're, I think, in a very unique spot where we have a great team, we're in a great market, with a solid business plan, and we have extraordinary investors, supporting us. So thank you very much to Nathan, Avi, Modi, of course, the whole J.P. Morgan team. So it's been a pleasure. I also want to introduce members of our team that are here today. We have John Schissel, our President and CFO. You're going to hear more from John in a few minutes. Dan Dooley, our COO. Austin Holderness, who runs our development group, and Carlos Olea, who's our Chief Accounting Officer. So along the way, we're adding some extraordinary talent to our team, and I think this group here, we're getting better and better every day. So these are pretty simple themes, and we have a pretty simple business plan. I think we now are in a position where we're one of the strongest and best office companies in the greater DC market. And our strategy is really to focus on where our customers want to be. So we're investing in developing heavily into urban areas. There's a big trend going on in DC and really across the US of urbanization. So there's increased residential, commercial, and retail use is really all coming back into the heart of the cities, specifically around transit hubs. And our strategy is very much to invest around that new demand into the market. Our team, I spent a moment on, so I'll move past that. A little bit of a view on where we are today. This is a snapshot of the company. So today, very much a Class A portfolio, 17 existing buildings totaling 4 million square feet. Our portfolio today is 90% leased, and when you look at the market statistics, the overall market is about 85% leased, so we're solidly outperforming, and that's due to the quality and location of our assets. And then we're very active in development, and I'll get more into that. But we see development as a unique leverage play for our company, where we have a strategic advantage in comparison to our competitors. So with a strong balance sheet and with less competition, we've had the opportunity to acquire some extraordinary sites and deliver some market-leading assets. We're also a unique platform. When you look across the DC market, we are really the only company in the office business that has experience both as a private company with very entrepreneurial roots. We started, with very little, not as little as Ohlone Hetz started with from a scale perspective, but we started small, grew on our own, grew to the point of going public, went private again through a merger with J.P. Morgan, and just 3 years ago welcomed Ohlone Hetz as a new investment partner. So this is back to strategy, and it is pretty simple that today in Washington we're seeing tenant demand for high-quality assets in great transit locations. There's really been a separation where pure suburban buildings, so in the Washington area, that's really buildings that are located outside of the Beltway, which is our main transportation, road. Buildings outside the Beltway have not done as well. There's higher vacancy, more distress in those markets, and the urban markets are really outperforming. So it's our tenants looking for that work-life-play balance in 24/7 locations. That part of the market is very strong. We're investing heavily into the operating side of our business, so as we scale, we need to be built for additional growth. So we're investing into our infrastructure, our team. We're building a best-in-class accounting staff, fantastic property management, very hands-on asset management, because at the end of the day, our business is a customer-based business, so it's all about KAR offering a better product and better service than our competitors. This is a bit more detail about our history, but it's hard to believe we've been in business now for over 20 years. Time moves quickly, and I feel blessed as well. I love what I do every day, love our team, so the time goes quickly when you're doing what you like. But I think when I look at the transformation we've gone through, today is the most exciting time for us because we're poised for growth and we have an amazing competitive advantage in the market today. So with support from our partners, I think you'll see this company is ready for takeoff. This map illustrates, the urban nature of our asset base. So you can see DC itself is kind of a part of the diamond, if you will. So you can see the diamond and then how it continues. The yellow line takes you across the Potomac River into Virginia. But inside that square is really the urban core of our market. So many of you, I'm sure, have been to Washington, but downtown, very commercial, 24/7, great transportation access. But there are, you can follow kind of urban nodes out from the city. So into Virginia, Arlington is very much an extension of Washington, D.C. Into Maryland, Chevy Chase and Bethesda are also very much extensions of D.C. So when we think urban, we think not just downtown, we think about these extensions that really follow out the metro line. Now our assets, you can see, are mostly inside the box. So over, today, close to 90% by value of our portfolio is all urban. And two of these red buildings, which are technically out in the suburbs, we will be selling. So one is under contract today with a firm deposit from a buyer, so that will close shortly. Another we intend to put on the market very soon. So you'll see us continue our transformation to an all-urban company. From an NOI perspective, today the existing portfolio generates about $95 million in net operating income. You can see that the implied cap rate based on the NAV of the existing portfolio is just under 6%. And on the development side, we have a total of 5 projects in various stages with total remaining costs of $1.5 billion. And the anticipated yield on those assets is just under 7%. So, look at the spread difference between development and existing. It shows here is just 1%, but I think in reality, the value of a completed new trophy development project, assets like that would sell for a price much more in the 5% cap rate range. So generally, we're really building to about a 2% margin over what we think the completed value would be from a cap rate basis. The DC economy is really starting to accelerate. Washington obviously has the federal government as a stabilizing support. So that, keeps the economy moving at all times. But what we've seen recently is demand really starting to build in the private sector. So technology growth in healthcare. So with the stabilizing force of the government, and then with the expansion in private sectors, this market is poised for real growth. So you can see the projections from Green Street Advisors forecasting marginal growth in 17 from an NOI perspective, but then a pretty accelerated path from that point forward as our market continues to firm up and demand continues to expand. So we are very unique as a company. When you look at the DC market, there are a number of public companies that have an existing footprint, but if you look at these statistics, under Carr, we're 100% focused on the DC market. The only other company that can say that is Washington Real Estate Investment Trust, and that's a mixed asset company. They invest in both residential, retail, so they invest across property types. We are only office and we are only DC. So I think at that time in the future when we do consider a public exit, that's something very unique that we offer. We're the pure play, high quality portfolio company only focused in DC, and that's a very unique advantage. The company has transformed, so we're both growing in terms of size, but also quality. I think if you look at the third bar here, the percent urban walkable to metro. So we started in 2013 when Ohlone Hetz invested into the company at about 77% of our assets really being urban in nature. So we were a mix of urban and suburban. We saw the trends that were coming with more demand for urban locations, and we have gotten ahead of that curve. So you can see that today we're at 92% of our assets are urban, meaning walking to within a couple blocks of metro stations. And once we complete our existing development pipeline, we're virtually 100% quality urban metro-oriented assets. So that's extraordinary. I'm not familiar with any other portfolio in the DC market that can make that claim. So growth. We've had a broad expansion over the last few years, and when we complete the build out of our existing pipeline, our growth is pretty extraordinary. So 72% growth in our NOI. And when you look at those numbers, most of that is known today. There's very little speculative growth coming from that NOI, and we achieve it through a mix of our in-service portfolio that we have today, plus expected increases in that NOI, and then delivering our existing developments. But out of our current development pipeline, as most of you are aware, that's about 2.2 million square feet. We have one option property. 862,000 square feet of that comes from the Washington Post headquarters, and that is now 750,000 feet of that project is fully leased to Fannie Mae. So there's tremendous certainty around that income. So we feel very good about the projections we have for growth and the certainty that it should provide. On the development side, it's all about quality. So today in Washington, tenants are looking for the best. I mean, there's a new trend in office where customers really want a great environment to work in. And so they're looking for tremendous light and air with full height glass. They're looking for great in-building amenities, so tremendous lobbies, fitness centers. So that's what our customers want today, and that's what we're delivering. So if you look across the board, we've delivered these assets, and when you look at our recent experience, delivering new quality buildings have led to success. So our 4500 East West Highway building we delivered a couple of years ago, we're now approaching 80% leased at that property. 1700 New York is really a jewel that overlooks the National Mall. That's just under 100% leased today. Midtown Center that I referenced, that's the new headquarters for Fannie Mae. That's all of the office space is largely leased. We have a very small piece remaining and about 50,000 feet of street retail that's being planned. So the point is the new product has done extraordinarily well. and we're going to continue to invest in high-quality development in A-plus locations. Digging in a little more on two specific projects, Midtown Center. This was a unique story, and I think it adds to our local market knowledge, and so I'll spend a minute just talking about how we got this transaction and where it is today. So the former Washington Post headquarters was located on this site. It's kind of a monolithic, old, gray building that really had a negative effect on the location, kind of a dampening effect. We saw it as a real opportunity, and due to the strength of our balance sheet and ability to move fast, we were able to tie up this site at a very attractive land basis. So I think if you look at our land cost, it was roughly 50% of what the land value would be today, so it was a very attractive buy. And we had planned, a cutting-edge mixed-use project in this location with a mix of perhaps some hotel, some office, really trying to create a dynamic environment. And it's evidence that when you're buying land in great locations at an attractive basis, customers, tenants will find you. And Fannie Mae ended up seeking out this site. We were in competition with a couple of other sites as well. And we, after much work from the entire team, were able to sign a lease with Fannie Mae. It is the largest private sector lease ever signed in Washington. It's got a gross value of over $1 billion. And so that's a massive win for our company. But what we're most proud of is really the iconic design of this project. It's very unique. In our view, this will be the best mixed-use project developed in Washington, certainly for the next 5 years. It'll be an iconic property when it's completed. And what makes it unique is, in addition to first-class office space, we have 50,000 feet of street retail, so it'll be a dynamic environment, real city square fronting onto L Street. So it's a special project that's located in the heart of the city, only 3 blocks away from the White House. So this is an extraordinary opportunity. The Apex site, this is a property that we currently have under contract. We'll be closing on by the end of May. We think this offers similar opportunities. So this site allows us to build about 940,000 feet in Bethesda, Maryland. It's located really right in the center of the market, on top of what will be a new light rail station that's being developed in Bethesda. So this project will be located directly over the new transit station, so the hub of the market. Our plan is for a mix of residential and office in this location. It'll be the best quality product ever built, tallest buildings ever built in Bethesda. So we think this is an amazing opportunity. And if we're fortunate, corporate demand could follow here, just like Fannie Mae followed into DC. So time will tell. We'll see how that plays out. 2311 Wilson and 2025 Clarendon Boulevard, these are smaller projects located in Arlington, Virginia. They're both just under 200,000 feet. Again, without question, these will be the best quality buildings built in the Roslyn-Ballston corridor, which is a major submarket in Arlington County. They offer unique design, great locations, 2 blocks from the metro, and should be very successful. 2311, excuse me, we're getting very close to a possible construction start. We've got active demand from a number of tenants. So once that pre-leasing is more firm, we would look to start construction of that project. 2025 Clarendon Boulevard, we're not quite ready. Again, we need to get the building fully permitted, ready to go, and see where tenant demand is at that point in time. But fortunately, tenants are very interested in assets like this, so I'm confident they'll be successful. In terms of development as a concentration in our overall portfolio, we look at it 2 ways. We look at it, one, without the credit for existing leasing in those buildings. Then we look at it without that leasing. So you can see that the company, in terms of development as a percentage of assets, does increase to just over 25% of total assets in the future. Actually gets up over 30%. But if you give credit for the Fannie Mae lease in particular, development is at a comfortable level. And over time, as we scale, development will become a smaller and smaller percentage of our asset base. On the acquisition side, I'd say we've been less active buying buildings that have been fully marketed. There's a lot of competition. There's demand from U.S. investors, demand from U.S. REITs, foreign capital. I mean, D.C. is one of the handful of gateway, most desirable markets in the U.S., so we face extraordinary competition anytime we want to buy a building. And I can't say that we're buying at discounts to market, but these are examples of off-market buys where at least we feel like we're getting a fair price, where there's less competition. So 1615 L Street is an acquisition we made in just recently in March. This was sold by a family who had major holdings in D.C., and we were the first buyer to get the phone call. The seller wanted a quick transaction, certainty of execution. We got the call and were able to complete the purchase. So the economics here, we bought the asset at just about $550 a foot at a going-in cap rate of 5.3%. So our plans here are really to transform the common areas of this building into something very special. It's a large asset, so we think with a targeted investment, we can create significant value. We also like the neighborhood very much. This building's located just a couple of blocks away from our post development. So, we're investing heavily in this part of the city, and we think there's going to be tremendous advantages spreading to other assets in the neighborhood. Columbia Center, similar story. This building is directly across an alley from the Washington Post site, so it abuts the Washington Post site. And our plan here is to create an extraordinary retail street between this building and our new development. So we have unique ways of adding value to existing buildings that others frankly don't have. And this was a privately negotiated purchase. We were able to work out the ability to buy this building while we were going through our development approvals next door on the Post. So we formed a relationship with a seller and were able to bring it to a successful closure. This building, when we initially looked at it, was about 80% leased. It's now full, basically, and we got, I think, a pretty attractive initial yield versus market at 5.8%. I'm going to have John Schissel, our President and CFO, come up and spend a few minutes on our financial overview.